What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training and welcome back to the home office. We are back from the Dominican Republic, getting back from the Life 180 agency retreat. By far the best event, most impactful event I have ever been to. It was freaking awesome. If you haven't checked out the videos, make sure you check them out. It was pretty sweet. So anyways, today I want to talk about or answer the question, is whole life insurance a terrible investment? I see this a lot. I see it a lot from people who are advocates of buy term and invest the difference. People from companies like Primerica, Dave Ramsey followers, traditional financial advisors and stuff like that. And then it's just when people say that whole life insurance is a terrible investment, it really doesn't make any sense to me, because here's the thing. Dividend paying whole life insurance is not an investment. It is a very efficient savings vehicle. But actually, before we even go into that, it's life insurance. You have investments over here that have volatility. They have the potential for loss. And then you have life insurance, whole life insurance over here, which does not have the potential for loss unless you're a dummy with your policy and you over leverage it. But that has nothing to do with the policy itself. That's on you. The policy just does what it does. It comes with these contractual guarantees, where it's guaranteed to grow at a certain rate every single year for the life of the policy. And then plus you can get dividends as well. But a whole life insurance, for example, the cash value of a whole life insurance policy cannot go backwards. An investment can. So when we're comparing, and that leads me to the next question, is when somebody says or asks if whole life insurance is a terrible investment, well, compared to what? What are we trying to compare here? Because if you're trying to compare what you would get in the buy term and invest a different strategy where you're investing in the stock market, well, you can't compare that to whole life insurance, because whole life insurance is not an investment. It's like comparing apples and tater tots. They're completely different things. For example, if you were interested in buying a guitar, would you compare it to a piano? No, that'd be ridiculous. So why are we comparing investments to whole life insurance? It really doesn't make any sense. And there's a couple of things that I wanted to share with you guys from just some concepts, some principles that I learned from a podcast that I listened to on the Better Wealth YouTube channel. Definitely check it out with Caleb Williams. He was having a conversation with a gentleman named Matt Love from Cashflow Architects. Also recommend you check them out. Check him out. Really, really good content. And he was saying one of the things that he said in the interview was that there's no such thing as a bad investment. There are bad investors. And that I thought about that for a second. It was like, wow, that's an interesting concept. And I tend to the more I think about it, the more I agree with it. Like, that makes sense. There really are no bad investments. For example, if you do invest money in the stock market and you lose money, does that mean that the stock market is a bad investment? No. It might mean that you did something wrong. Maybe you were trading emotionally. Maybe you sold, you bought at the top and sold at the bottom. Who knows? Right. But then there's also people that do well in the stock market. I know successful traders, not very many, but that just because you might lose money in the stock market doesn't mean it's a bad investment. Same thing with real estate, same thing with cryptocurrency, Bitcoin, gold, commodities, you name it, whatever investment that you are making. It's not that any one of them is good or bad. They just are. They're just financial products that we are able to utilize based on we're able to utilize them to build our wealth based on our values, beliefs, principles, our goals, lifestyle, financial situation, things like that, right? But the other thing that he said that really, really resonated with me is that we don't set policies up for the rate of return, because I am the rate of return. And I absolutely love that, because it speaks to what for example, the infinite banking concept is at its core what it's really about. Because the infinite banking is just a strategy. Dividend paying whole life insurance is just a financial product. All right, that's it. How we use it, how we implement it in our lives dictates what it can do for us. Now, obviously, there are benefits that come with these whole life insurance policies that even if we were to not utilize them to build wealth, it does still help us build wealth because it grows every single year. You can get dividends. Of course, you have the death benefit, which is huge for passing on a significant amount of wealth to the next generation, income tax free. You have living benefits as well, acts as an emergency and opportunity fund, etc. All right. But here's the thing. When he said that, it really resonated with me because I think about like how I'm using my policies right now to build wealth, where the policy is going to do what it's going to do. They typically will average about 3.5% to 5% tax-free compound growth for the life of the policy. All right. But I can borrow against it and use my knowledge, my training, my abilities, my gifts, whatever, to then go out into the world, seek new opportunities, meet other entrepreneurs and investors and things like that, and discover these different investment opportunities that I'm able to take advantage of utilizing my policy, right? So in essence, I am the rate of return. I really, really agree with that because it comes down to what are you using the policy for? Like, how are you utilizing it in your life, right? So we don't set policies up for rate of return or treat these policies, whole life insurance, as an investment, because it's not. And here's the thing. So when people say that whole life insurance is a terrible investment, so you're saying that if there was a savings account that was going to pay you around 4% tax-free compound growth the rest of your life, it would also allow you to utilize the money in the account to go build wealth and maybe invest in your precious stock market if you're that confident in it. All right. All the while not interrupting that compound growth. Plus, if something were to happen to you and you were to pass away, they would pay out. They would pay out an income tax-free death benefit 20 times the amount of money that you have in the account. You're going to tell me that's a bad investment? First off, it's not an investment. I said savings account. Right? You wouldn't compare a savings account to the stock market, would you? So why are we doing it with dividend-paying whole life insurance? I think it's because people try to sell a very specific narrative, ideology, certain financial products that might not be in alignment or in the best interest of people because you don't actually take the time, they're not actually taking the time to understand what people's needs are, what they're trying to accomplish, and also having a very, very fundamental misunderstanding and or a misunderstanding about how whole life insurance works. I think that's where it really comes from. The problem with that is that it doesn't serve people. It can lead people to make decisions that might not actually be in their best interest because it's based on wrong information. Like the content that I see that bashes whole life insurance, like I don't care if someone doesn't like whole life insurance. It's definitely not for everybody. Even though it can provide a very, very strong financial foundation for us. But whatever, I get it. It's not for everybody. But where I have the problem is when people start lying about it or providing misleading half-truths and inaccurate information about it just to promote this narrative over here, usually buy term and invest the difference, right? But yeah, what's funny about this is like, if you're so confident in the stock market, why not put your money into a whole life policy first, build that financial foundation, get the tax-free compound growth, get the death benefit, living benefits, all of the amazing things that come with these policies, borrow against the policy. Of course, you set it up for high cash value, so you can do that within the first 30 days, and then invest in the stock market. You have to pay interest on that. It's simple interest. But hey, the market's going to go up 8, 10, 12% on average every single year, right? Oh, no? All of a sudden, the narrative changes. That doesn't make sense anymore. It doesn't make sense to borrow at 5.5% and make 8, 10, 12% on average every single year. That doesn't make sense now. So which one is it? Right? You can't have it both ways. It's either you are very, very confident in what the market is going to do. So why not build the financial foundation first, borrow against the policy, pay a little bit of simple interest. Now that's where you're getting the positive arbitrage. The whole thing about positive arbitrage in the policy is just ridiculous. Do not listen to that crap. Can it happen every once in a while where I borrow against my policy at 5.5% and my policy maybe earns 6? Maybe, but it's rare, and that's not why we set up the policies, okay? Where the positive arbitrage comes in is how you use the policy. So I borrow at 5.5%. I'm getting into private money lending, so maybe I lend it out at 12%. Now I'm getting positive arbitrage there. But again, it's me doing that. I'm the rate of return, making that happen, understanding how these investment opportunities work, networking, creating those opportunities in my life, right? Because they don't just show up out of nowhere. And you have to understand what you're doing too. Otherwise, you can lose money. And which, again, going back to one of my original points, this doesn't make it a bad investment. There are bad investors not understanding what they're actually doing. So if you're so confident in this buy term and invest the difference, well, why not do both? Why not invest and buy whole life insurance because of all the benefits you get? And you can pay up a dividend-paying whole life insurance policy too, guys. You don't have to pay into it for your entire life. You could fund it for a certain period of time, never make another premium payment ever again, and it's still going to grow for the rest of your life. And that death benefit will be there when you pass away to give to your loved ones. You'll have the living benefits, when you need long-term care and have medical expenses and stuff like that. So why not set that up, borrow against it, pay a little bit of simple interest, put it in the stock market, get your positive arbitrage there, and now you have, you're doing pretty good, right? Oh, but yeah, you're not really supposed to go into debt and leverage something in order to invest in the stock market. Why? Because the stock market is extremely volatile. Nobody knows what it's actually going to do. The only time people actually know what it's going to do is when they're talking bad about whole life insurance. That's it. But then as soon as we start looking at a scenario like what I just explained, oh, no, that's horrible advice. You don't do that. Why not? I thought you were so confident in the market. I don't know. But you can't have it both ways. You're either really confident in the market or you're not. For me, I don't like the stock market. I don't use it to build wealth. A little bit. Like it's going to be a very, like, right now I'm not invested in the market. I am looking at opportunities like real estate investment trusts. Right now, I'm also looking at TLT as well. This is not investment advice, guys. I'm just sharing what I'm doing in my life, and I put pieces of the puzzle together using just paying attention to like what's happening in the overall economy and et cetera, et cetera. At some point later on down the road, will interest rates go back down? Yeah, I think so. That means that TLT would be a good opportunity. But again, I'm not just blindly throwing my money into the market like so many people do, like we're taught to do. Because like with 401ks, for example, I'm not a fan of 401ks at all. I think, they're right for some people. I don't think they're a scam. I don't think that they're a terrible investment. I just don't think they make sense. That's all. It locks up your money. You have no idea what the market's actually going to do. The fees compound against you over time. Like it's not in alignment with my core values, my beliefs, my principles, and what I'm trying to accomplish. Right. But I'm just not a big fan of gambling in the market, because that's what a lot of people are doing. Like, can you confidently tell me what the market's going to do over the next 30 years? Nobody knows. And there's a lot of chaos right now, a lot of economic uncertainty. How do you know we don't go into an economic depression and the market goes down or sideways for the next 5 to 10 years? Right? How's that going to impact your retirement? Even if it does perform, maybe it doesn't perform as illustrated, what was shown to you by your advisor. Maybe, they showed you 8% every year, but you, like, by the time you're ready to retire, it only averaged 6 or 7%. What are you going to do? Right? Do you have a plan for that? And so the fact that we don't know what these things are going to do, I don't know. Is the stock market a terrible investment then? I mean, there's an argument for it. I don't think the stock market is a terrible investment. Just like when someone says a whole life insurance is a terrible investment. No, it's not. It's just life insurance. It's just a financial product that has certain benefits. It provides a certain type of, it provides a really strong foundation, provides certain types of benefits, and that makes sense for some people. But it's not an investment. It's a very, very efficient savings vehicle that allows us to build a very powerful financial foundation that will help us accelerate the wealth building process in our lives. How do I know that? I'm using it in my life right now. That's why I'm a huge fan of this stuff. So anyways, I'll go ahead and wrap up there. Let me see if I had anything else here. I had some bullet points. Yeah, I think I covered just about everything. So I hope that helps, guys. I hope that answers that question and clarifies that argument a little bit, because it's just a wrong way to think about that. Like, if you're thinking about whole life insurance as an investment and you're only focused on the rate of return, you are completely missing the point. And you need to do more research about how these things actually work and what they are able to do for us, because they are really, really powerful. And once you have all the information, the facts, and you understand how it works, now you can make an informed decision. And maybe it's right for you, maybe it's not. But you need to, you can't stop at just, oh, it has a terrible rate of return and it's a bad investment. That's ridiculous. One example, just to finish up, an example I give is like when Warren Buffett is considering buying a company or investing in a company, does he only look at rate of return? Does he only look at one aspect of the company? Like maybe he just looks at the income statement and then stops there and makes a decision based off that. That would be ridiculous, right? He looks at the income statement, the balance sheet, management, overall economy, the what's happening in that industry, the markets or the supply and demand of the products, whatever. Like he probably does a crap load of research and has a formula for that. So he puts the whole picture together, right? He doesn't just go, oh, that gets a good rate of return. All right, let's do it, or let's not do it, right? You have to look at the full picture here, all right? So I hope that was helpful, guys. If you have any questions and or feedback, I would love to hear that, hear it, whatever. Drop it down in the comments section below. I love engaging with you guys in there. We've had some good conversations in the comments section. It's always fun. But also make sure that you check out the links in the description. I have some really good additional training and resources there about infinite banking, whole life insurance, all that good stuff. Make sure you take advantage of that. But either way, I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.